All right, welcome everyone to today's Sunday macro wrap up for Sunday, August 10th. Taking a look at some of the data here today. This graph right here is the S&P 500, so the stock market, subtracting the top 10 stocks. And so, this chart looks a lot different from, the regular S&P 500 because, let me see if I can pull that up here real quick. So if you guys see here, the differences in the two charts, the S&P 500 minus the top 10 stocks really has not been performing too well, right? It's pretty much remained flat for the entire year of 2025. It's right back to where we were back in December of 2024, but before it had its huge drop off. And so the concentration is super high within the top 10 stocks. If you want to take a look at the S&P 500 market breadth, which is this chart right here. So this is the percentage of stocks within the S&P 500. So when you take a look at all 500 stocks, the percentage of those above their 200-day moving average is at 57%, right? Almost 58%. Now, this is a little bit different from when we look the last time that we had the market at all-time highs, all the way back in November of last year. The market breadth then was around 72%, right? So it's narrowing at these higher new all-time highs. And then just going back to the 2021 all-time highs, that was around 89, 90%. So it's interesting, as we continue higher with the entire stock market, the breadth is narrowing, which typically isn't a sign of long-term health, right? We saw something similar back during the 2000s dot-com bubble. I'm not saying that that's exactly what's happening right now. It's just showing that there's less stocks, keeping this thing going. And so the only problem is that when you're heavily reliant on just, a few names, well, when those start to reverse on you, then you could have some big problems there. And so one thing that I also like to look at is, and always remind myself, is that when you take a look at the stock market itself, what you have to understand is that it's not so much about all these companies performing really well and doing better. It's that the underlying denomination, which is the US dollar, continues to deteriorate in value. And one graph that shows this is the S&P 500 versus gold ratio here. And so, gold is something that is considered an inflation hedge. It's a what's called a hard currency, and so seeing that it's pretty much dollar proof, right? If you compare the S&P 500 and denominate that in gold instead of dollars, you get an entirely different chart. And so by looking at this, we see that the S&P 500 denominated in gold instead of dollars is around November 2020 lows, right? In fact, that little April crash that we saw, if you were just looking at S&P 500 versus gold, it was pretty similar in magnitude to the COVID 2020 crash that we saw back here. And then if we take the RSP, which is the equal weight S&P 500, that looks even worse, right? So again, the equal weight S&P 500, this is if you took all 500 stocks within the S&P and had each of them weighted equally, right? Because pretty much the top 10 make up nearly 40% of the entire index. But if you take all 500 stocks and equally weight them, this is what the actual index would look like. And so, as you can see, it's pretty much the market has remained flat for the better half of the last 8 months or 9 months rather. And so, I saw this one tweet here. Let me see if it'll pop up. 1 second. Where did I put that here? Was it this one? No, we'll get to that in a second. I saw an X post where maybe I can bring that up in a little bit, but it essentially compared earnings growth, pretty much since the pandemic or since 2022. And really, earnings growth has only been seen in the top 10 stocks for the past 3 years, right? Pretty much the S&P 500 490 has remained flat in terms of earnings growth. And so what that points to really is that for the majority of the market, I mean, it's having it's having a hard time in this environment with high rates. And so just taking a look at the SPX isn't necessarily a good indication of how the entire market is doing. Nevertheless, we want to still remain bullish on something that remains in bullish trend. And that's why, I still have the bookshelf in the background behind me as a green color because it remains in bullish trend there. And so it'll remain that way as long as this maintains trend here. Now, in taking a look, let me see if I can bring up the SPY. Actually, I don't know why my computer is going a little bit slow here. There must be some type of tab that's causing this to freeze up. But let me see here. For the people on Zoom, is it breaking up a little bit, or can you guys hear me okay? As well as for the people who are on our stream here.
I can hear you okay, but your image is like freezing.
Oh, okay, so my face gets frozen from time to time.
Get frozen. Now it's not frozen. It was a couple of seconds ago it was.
Okay, gotcha. Well, maybe it's just maybe it'll just catch up here. I do have a lot of tabs open on other screens, so maybe that's the case. But we'll continue in any case. If things are frozen, you can still listen to the words that I'm saying. So, yeah, I mean, the S&P 500 still remains in bullish trend. Just know that it's being carried by in large part by just the top 10 names. And then, taking a look at gold, gold is signaling right now. It looks like it's signaling a breakout here. Let me see if I can pull it up. But, looking at the gold chart, this thing continues to rise as the government continues to just have insane amounts of deficit spending. And so, I mean, that's going to continue to happen until really rates get lowered or something breaks in the economy. And what gold is signaling right here, if the chart ever pulls up, is that it looks like it could break out just based off of everything that's going on underneath. So hopefully it pulls up here. If not, we'll just continue on into the macro data. Yeah, so here we go. Gold, it's been testing the, its all-time high here for 4 times in a row. That's $3,434 per ounce of gold. And so, it's pretty much since April been doing this test of that level here. And, typically when it's doing something like this and consolidating, it's looking to break out here. So, I mean, I wouldn't be surprised if we start to see a more aggressive move in gold here coming up, similar to what we saw during the first, few months of 2025. So gold is definitely one to, keep a decent amount of. That's what I'm doing personally in my portfolio here. When in terms of the U.S. 10-year government bond yield, which is a good signal of the bond market trying to price in growth and inflation expectations, it continues to do this pong between 4.5 and 4.2, where it gets up to these levels from inflation expectations rising, and then it falls after we start to get some bad growth data. And so this is really the stagflation pong that we've been playing, pretty much since it goes as far back as September of 2023. Yeah, I mean, the only thing that I see that would get this down further is if we just had a recession or something. Because as we saw back in September, when the Fed lowered by 50 basis points, what did interest rates do? They actually went in the opposite direction, right? They cut in September, and then the 10-year bond yield went up by 100 basis points. So for everyone who's calling for cuts, rate cuts, that's all you see on the entertainment news networks like CNBC, Fox Business. They're all calling for rate cuts. The thing is that, as well as the president, but when they cut rates, if inflation isn't tamed, which is what the Fed is worried about, then the actual rates that are tied to things like 30-year fixed mortgages, credit cards, that'll just have the opposite reaction if inflation isn't tamed. In fact, it'll just put gasoline on the fire and cause inflation to go up even higher. And so you got to be careful for what you're wishing for if you want the Fed to lower rates, because the Fed funds rate, which is what they control, is really the rate that financial institutions pay amongst each other. The rate that you and I pay as consumers is more so based on the 10-year U.S. government bond yield, which that isn't controlled at all by any type of government. Like this is being priced in by market participants, right? So yeah, we're kind of stuck in this dilemma until something breaks or we somehow by a miracle grow out of this. It's just taking a lot longer than what has been anticipated because of the sheer amount of government printing that happened during COVID. I always like to put this in perspective for those who are new to the stream here. But when the Fed was created in 1913, it took them from 1913 to 2019 to essentially be able to print $4 trillion on their balance sheet, right? So nearly or more than 100 years to get to 4 trillion. COVID happened March in 2020, 1 month in March. They doubled it. So in 1 month in March of 2020, they did as much damage as 100 years, right? So they went from a $4 trillion balance sheet to 8 trillion in 1 month. So that's just like the scale of it, right? And of course, that's going to reverberate through the markets for decades from now, right? And so when something like that happens, I mean, it's essentially a nuclear bomb of liquidity. And so a lot of these things that typically take, maybe a couple years when you have, like a yield curve inversion like we've been seeing over the past couple years, usually is anywhere between that 18-month period. Well, it's been extended a lot longer than that because of just the massive amount of government printing that we saw. All right, let's zoom in here to what happened a little bit last week. The key highlight to last week was the continued slowdown in the services sector. You guys have heard me talk about this before, but I'll keep repeating it. Services make up around 50% of the entire U.S. GDP. Services makes up the majority of the consumption measure. And so when you look at consumption, that's around 70% of the entire GDP number, which includes goods consumption and services. But then when you break that down again, services is mainly the largest component of GDP. And so this continues to trend lower. But what's interesting is that when you break down the two most important components that you want to track, one is new orders, right? Because that's future demand. That continues a downtrend here. And when you go back 10 years, it's at pretty low levels historically. if you max that out to going all the way back to 1998, you can see that, at 50.3, that's pretty much, the lowest that we've seen on average since August of 2009. So if you just, extend that 51 all the way over, pretty much from the great financial crisis until now, it's been above that level. So we're clearly seeing a deceleration here in new orders, similar to what we saw back in 2006 and 2007, right? And then on the other end, with prices, so price inflation, that continues to go higher. Let's go ahead and extend that back to 1998, right? So we see that we're nearly at 70 points. There's really only been a few times in, the last, 25 years or so that we've been at these levels. And what's interesting is that when you look at both of those two things at the same time, which is this chart right here, and I'll try and let me see if I can. I know there's a lot going on here. The white marker here is the stock market. The orange is prices, the price index that we just looked at, and the blue is new orders. The reason why I have this marked here is that there's really only been two other times where new orders have been below 54, while prices have been above the 67 index. That was briefly in February of 2021, which it really wasn't a sustained, drawdown in new orders, right? You had a very fast rebound to new highs. And then the only time before that was November of 2007. Now, I'm not saying that we're having another 2008. That's not what I'm saying at all. It's just when you see these two divergences that are happening pretty rapidly, right? Pretty much ever since December, we've seen a rapid acceleration in service prices. That's not a healthy thing to see, especially with the way that things are slowing down at the same time as we see with new orders. And that's why the title of this video is The Countdown to 2026, because typically that's one of the first signs of more of an aggregate slowdown, because again, we want to focus on services. In 2023 and 2024, a lot of economists were hyper-focused on just the manufacturing sector, which continued to show a contraction, but then the services sector continued to show expansion. And so that's kind of what carried it forward. But now, seeing that services are slowing down, we need to start paying attention here. Ellie asks, can you show the ISM chart again, please? Sure. This is the one going all the way back to 1998, right? So at 50.1, pretty clear the trend there. All right, so what else do we have for you?
Johnny, I have a question. So the jobs market is weakening. Then we have orders weakening. We have so we could expect some type of recession, like you said, coming out in 2026. But what does that mean to the stock market? Because the stock market is driven by, I don't know, 10 stocks that seems to be like recession friendly, because they are pulling a lot of productivity issues, and I will think that companies will go to productivity, hurting more the jobs market. So what does that mean to the stock market at the end?
Yeah, good question, Ricardo. The way that these Sunday macro wrap-ups work is I typically go through everything, and then at the end we'll tackle some questions. So just hold that thought there, and we'll get through it. After once we transition to the other half of the stream here. Because the way that these Sunday macro wrap-ups work is that the first 30 minutes is streamed online, and then the last 30 minutes to 45 minutes is offline, just between the Macro Optics members, and we'll go over some ideas as well and answer those questions. But great question, though. I do want to answer that, but we'll just put a pin in that real quick. going through this, we also got the Treasury auctions for the 10-year and the 30-year. This actually showed Treasury yields bounce on that. I won't go over the specifics of the Treasury announcement here, but essentially the takeaways is that even though you saw pretty much what was expected, you saw a very large deceleration in foreign interest in treasuries, and so you had a little bit of an uptick in yields there, and so it's not necessarily like an alarm, but definitely interesting seeing a disinterest or a much an unexpected disinterest in 30-year in 30-year bonds from foreign participants. We also, I always like to bring up these headlines because they typically focus on month over month data. But when you look at consumer credit, both revolving and non-revolving consumer credit, revolving is things like credit cards, stuff like that. Non-revolving is like 30-year fixed mortgages, auto loans, that type of thing. So what's interesting is that revolving credit is actually negative year over year. While non-revolving credit, did have a little bit of a bounce, but both have been continuing to weaken at the same time. And really, when both these two slow down, if they start to go negative, that's definitely a red flag there. But this is just one other thing showing the state of the consumer with slowing. I got a lot of people asking me about this week, the retirement market to open it up for crypto assets. So right now, a lot of these headline news might be great for crypto, but you have to realize that there's always an underlying, read between the lines reason why the government does anything, right? If you're someone who's just watching TV and they're like, wow, the government must really care about the citizens here. Just keep asking yourself, what's the reason why they're doing this? And obviously, it's because they are super in need of cash right now. And so they're trying to drive whatever streams of cash necessary into the markets as they are drying up in terms of their liquidity reservoirs. So as we know, the reverse repo facility, which had around $2 trillion stored up in it, that has been pretty much drained. They still have about 80 billion left in here if they do want to get that to zero. I'm not sure how much they can use of that still. So this is pretty much all gone. And then the Treasury General account has actually been refilled up from the remaining of the RRP here because they're trying to increase cash within this government checking account that's held at the Fed. And so as the government continues to just print money via short-term bill issuance in order to fund the deficits, they're going to continue to need more cash on hand. It's similar to where, like, let's say you have a higher credit limit on your credit card and you keep on spending, half of it. Let's say you have like a $20,000 max credit card limit and, you're running up, $10,000 to $15,000 of it every single month. Well, you're probably going to want to hold more cash in your checking account, in order to cover that, right? And so the further and faster the government keeps on going into debt, the more cash that they want to have on hand. And so that's the name of the game right now that the Treasury is trying to do, is that they're just trying to put as much duct tape and Band-Aids on this thing until somehow, some way, rates get lowered. And, I've had some people say, like, they need to lower rates because the government is, going further and further into debt. The only problem is that if the Fed, who claims they have like a dual mandate of stable prices and full employment, as well as they say that they're independent from the government, well, what does that tell the entire world once the Fed cuts rates because the government wants something done, right? That's typically, at least publicly, not how it works. Right? Typically, they lower rates because there's an imbalance between prices or employment. And right now, you still have inflation at 2.7% with headline. And then if you just look at the unemployment rate, it's at 4.2%, 4.1%. That's still incredibly low if you're just looking at it. We won't get into if those numbers are manipulated or not. That's a whole different discussion. But on the surface, you still have relatively lower inflation and you have relatively stable, a stable labor market, according to them, right? We can get into that discussion another time. But just by looking at the headline numbers, that is not telling the Fed to cut. And so if they were to cut here, it would just totally tell the entire world, like, yeah, fiscal dominance is in full blown effect. And that always leads to really bad outcomes. And so the Fed is really trying to avoid having to cut rates for the sole reason that the government needs help, right? So just keep that in mind. All right, let's go ahead. What else was I talking about here? Oh yeah. So one of the debt instruments that I like to cover is emergency cash bills, which are these cash management bills. This goes back into the Treasury Department needing emergency cash, and we've had a huge acceleration in that pretty much ever since the S&P 500 is in red here. But I'm going to see if this is going to continue higher, because this is a signal of potential early stress if the government is trying to, increase their issuance of cash management bills, which are essentially treasury bills, but they are custom maturity, pretty short term, anywhere between like a few days to 50 days. But it's like just a set term. It's not like the standard like 16-week, 52-week, or whatever. So, in other words, when these are at elevated levels, that's typically a sign of stress underneath, and we just had a huge spike there. Getting into stuff this week, we have inflation on Tuesday, CPI, PPI on Thursday, which is producer prices. So that's input prices. Consumer is the consumer prices. Producer prices is what businesses pay. And then we have core retail sales on Friday. So pretty decent week of macro data this week. I wouldn't be surprised though, just by looking at the break-even inflation rate right here. So this is the 5-year break-even inflation rate. Let me go to lines. This did have a slight deceleration in July. So I wouldn't be surprised if this either came in as expected or possibly slightly lower, which would give, people to point to like, hey, Fed, there's your slowing inflation number. You should cut now. And then the Fed will probably come out saying like, okay, 1 month isn't enough. We need to see multiple months of it trending downward before we can consider cutting rates. And then with a lot of the tariffs finally going into effect, they still are in this unknown world right now until they get the actual data, which will be well into the fall before we get into that. And then, as you can see recently, though, pretty much since the beginning of August here, inflation, the 5-year break-even inflation rate has ramped back up, which is why when you take a look at the Cleveland Fed's inflation nowcast, you have the July headline CPI, because right now headline CPI is at 2.7% for June. They have that staying right where it's at, which could be below expectations. And so you might get a little bit of a 1-month celebration of, yay, inflation's coming down. But then they have it ramping up right back to 2.9% for the August print that gets announced the second week of September, which is the 1 week before the September FOMC, the Fed meeting. So just keep that in mind. You might see a bunch of headlines this week saying like, all right, inflation's coming down. We need a cut now, which will then, possibly make the target rate probabilities for the September Fed meeting go even higher. But then once you get more data heading into September, you might get more of an evening out of that as inflation continues to accelerate to even higher. As of right now, going up to 2.9%. Core CPI remaining at 3%. That's not 2%. So we're not trending near the Fed's 2% target, right? They didn't even cut in, earlier this year when this was trending towards 2.3%. What makes you think they're going to cut right up here, right? So that's what I'm seeing there. And so, yeah, that's pretty much all I have for you guys here this week in terms of expectations. But yeah, just taking a look at gold, taking a look at the bounce in yields. It's this entire debate for Fed cuts, I think, is just going to remain on the table. And, there's only two ways that we get out of this with rates being lowered. One is a recession. That'll definitely get them to lower rates. Two is if somehow this AI boom, all the capital expenditure that's going into AI suddenly and rapidly transfers into organic growth via efficiency and productivity booming, then that's another way out of it. But until then, and typically the productivity boom happens on a huge lag because you have CapEx and then you have that transformed into actual productivity. AI is moving pretty fast. So, I mean, that's still up for debate whether that happens. But those are really the two outcomes that gets us out of this stagflationary environment, right? Until then, we're just going to remain in this no landing environment where rates remain, relatively high. And we just continue seeing the market being grinded upwards by the hyper concentration in the top 10 stocks. So, and then obviously you get different booms and busts of the sectors that we've been covering as well. So, yeah, that's pretty much all I have for the stream here. For those who are on the Zoom call, stick around. This is only the first half. We're going to transfer over. For those who are watching on our socials, if you guys would like to join the chat after this, we're going to go into questions. We're going to go into some actionable ideas and get into a little bit more of some of the off-topic conversations that we had mentioned before. But if you're interested in that, we have a free trial of our macro investing community. You can just go to our website there using the links and stuff. But until then, we will talk to you guys next week. Good luck out there, and happy Sunday.